Now, I want to speak more broadly about what we're seeing in the markets this morning and this week, especially as we await some important data coming tomorrow and Friday. Helping us do that this morning, Eddie Ghabour, owner at Key Advisors Wealth Management. Eddie, great to see you. We've got some green on the board again today, another positive day, but again, sort of sideways. Not a lot of movement and still seeing this heavy rotation trade here. What are your thoughts about the action we're seeing so far this week?
This is falling right in line with our theme for 2026, as we've been pretty vocal about the fact that we think there's going to be new leadership this year. We've had a great run in technology for the last 3 years, but technology, in our opinion, is not going to lead the way this year. You want to be tilted towards economically sensitive areas and very underweight technology. I tweeted out the other day that you get any major bounce in software, which you've gotten the last 2 trading days. I would look at that as an opportunity to lighten up for those that are overweight tech, because I don't think that the rotational trade is even close to done yet. So we expect that to accelerate, because we think technology is going to really struggle even more in the second quarter. So this is a bet on the economy and going underweight, an area that's just had a banner few years, and now it's time to just take profits, in our opinion, and rotate into other areas that are much stronger.
All right, so Eddie, I was just talking to Kevin Green about Datadog and the move we're seeing on their earnings right now, up about 15%. Are they a candidate for what you're saying right now to take this bounce and reallocate?
I think when you look at these names, it is not normal to see the volatility that we're seeing in these names. It's very similar to what happened with Palantir post-earnings. They were up 12% that morning after and gave it all back plus more. So I think that's going to be the trend. Now, it's not going to happen to every single technology stock, but I think as a whole, when you look at the IGV being down 20%, already to start the year, speaks volumes about the fact that the bar is set too high for earnings for technology, and it's really low for the economically sensitive areas. So I think these are going to continue to see this type of whipsawing with the trend more downward than upward for most technology names.
And you just mentioned Palantir. I know that you fully exited Palantir last week. You disclosed that to me before the show. What's your concern with the stock at current levels? Because we also just got a note from Daiwa today upgrading the stock, and they're taking a more bullish stance.
Well, look, the market's speaking for us, so it's not a matter of opinion. It's the fact that they had an amazing earnings report, and they still broke under the 200-day moving average. So we're not going to try to catch a falling knife. And we don't really fall in love with a name. It's a great company. We made a lot of money on and Palantir, as many investors have. But every stock has a time when a cycle ends short term, and then it corrects to get valuations down, and then you can go back into that position. So that's our opinion. We think that name could easily get to $100 in the next 6 to 8 months, and we'll buy it back. I hope I'm wrong, because I don't want to see investors lose a lot of money. But when you look at the technicals on that stock, I would be very hard-pressed to upgrade that after the fact that it couldn't deliver after amazing earnings. So I think the next quarter is going to be even rougher for names like Palantir.
So if that thesis proves true, and we are going to continue to see tech struggle the way that it has so far this year, you actually say the market you think is getting healthier more broadly. What signs of broadening are you seeing beneath the surface that lends itself to that thesis?
So when you look at what has been performing this year, which again, we keep talking about the economically sensitive areas, when you look at industrial ETF, you look at home builder ETF, you look at the small cap ETF, and you look at regional banks. These areas are up 9 to 12% already to start the year, while IGV's down 20, while the Qs are basically flat, and the S&P is up just less than 2%. This is a major outperformance, and I think this is indicative of what's going to happen this year. We are going to see the economy accelerate. And the more this disparity in returns happens, the large institutions are going to be forced to sell the most concentrated trade in Wall Street, which is technology. They will be forced to sell technology, and the money flows are going to continue to go in these areas, in our opinion. So it's a great market if you're in the right areas. And like I say, it's healthy because there's a lot more players in the game now versus just technology. And I think that's a real positive.
All right, so you like regional banks, and I know that you also like housing. You take me through your bullish view in housing right now, and if there are any specific names that you like there.
So we have been underbuilding for a while in housing, and one of the things this administration has really talked about is trying to get housing back going again. And whether you agree or disagree, whatever their policies are, the one thing with this administration is when they say they're going to go after something, generally they do. So, and the market is speaking to us. So we are in the ITB, which is the ETF for clients. If you want to look at individual names to be more aggressive, a name like Toll Brothers. And this is a real contrarian play. A lot of times going to places where most investors aren't can be profitable. And the last 2 years have been really bad for housing. So we think this is a year, at least for the first 6 months of this year, where we're going to continue to get some major outperformance. So are they going to go up 12% a month like they did this past month? Of course not. But I think the outperformance relative to tech and the S&P will continue to broaden out.
And as far as housing goes, Eddie, how sensitive is this housing call to interest rates moving lower?
Well, interest rates obviously are going to be, we can't see interest rates go high, right? We can stay at these current levels in the 10-year and even go to 4.3, 4.4%. Now, if we start going to 4 or 5 because of inflation accelerating, that will be a headwind for housing. But we think the inflation data that we're going to get this week and next month is going to show a deceleration of inflation. And I think the bond market has already sniffed that out, as you've seen the 10 years back down to a level we haven't seen in a while. So we think we're going to stay range bound. And we're in an area where interest rates right now, I think, are low enough to get the economy going as well as get housing going again.
And Eddie, as far as your outlook for the data that we're getting this week, the delayed jobs report, also the inflation data on Friday, what are your expectations there? And also, how influential are they going to be in terms of potentially changing the path of the Fed? Because right now I'm just looking at it, and March is pretty much priced out at this point, a cut coming in March.
I think after this week's data, you're going to see the probability in the bond market of a rate cut in March go up substantially, because I think the labor market is going to show continued weakness, and I think inflation is going to show trending down. And so I think what will happen is you'll see the bond market, and maybe that's what the 10-year is telling us today with where it's at, that this inflation number that's going to come in is going to be very dovish numbers, as well as the data that we're going to get on jobs. So expect the probability of rate cuts to increase substantially after this week is how we're positioning.
All right, Eddie, we'll see. We'll get that data tomorrow, the first half of it, the rest on Friday. But we appreciate you being with us as always. Eddie Ghabour, owner of Key Advisors Wealth Management.